walk us through like maybe how the algorithm works?
Yeah, so the algorithm begins by combining many different signals that predict the market. Now, most of these signals are trade secrets, but one we often like to talk about is the STIR signal. Now, STIRs are short-term interest rates. These are futures contracts that trade in markets all around the world, and they are the market's prediction of where interest rates are going. Now, if STIR futures are falling, that means the market is predicting that interest rates are going to rise. And if interest rates are going to rise, we think that the FX markets are generally going to follow. So what the system is doing, it's sitting there, it's watching all of these different STIR futures markets. Futures are falling, interest rates are rising. The strategy is going to tend towards buying the currencies that match those interest rates.
Yeah, and I guess another very important thing is it's always looking at the cost of trading. So it might say it wants to be long, say, euro dollars, but it won't go long unless the cost of taking on that position is less than the expected benefit of holding that position.
Yeah, that's right. And another consideration is the overall risk of the position. The algorithm will consider the correlations between different currency pairs and will consider spreading risk between those pairs. So to continue our STIR example, if the STIRs are showing that the US interest rates are going to rise, the strategy might be buying US dollar CAD, it might be selling the pound versus US, selling euro versus US. Now that's a way of taking a long US dollar position, but spreading the risk between the Canadian dollar, the pound and the euro. And as you can see on this slide, this is just a short little example of how our signal maps across to the sort of position that the strategy might take.